Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to talk about saving for retirement, and specifically how to prioritize the various accounts that you have available to you as a physician. And this is a common question we come across. People know they should be saving for retirement, but there's an alphabet and number soup of different accounts they can save to, so they wonder how to prioritize them in terms of what to save to first, second, third, etc. And it can be even more confusing because the different accounts all have different features and tax treatments, and sometimes people don't even know which accounts they're eligible for. So it can be hard to figure out the order of priority when thinking about them. And the title of this episode explains the idea. We all have a certain amount of money or cash flow that we're able to save for retirement each month or each year. So the question is how to optimize it across the different accounts. And we use the waterfall analogy because for each physician, there's a certain optimal order of accounts. And when looking at your available cash flow, you want to first fill up the most attractive account, then the next most attractive, etc.
Yeah, and while we describe this as a waterfall, don't worry, there won't be any TLC references about chasing waterfalls.
Wow, that's a throwback right there, but yes, we can promise that. So understanding the order of where to save first is especially important because not everyone has enough cash flow to fill up all the available accounts. And going back to the idea that different accounts have different tax treatments, by being smart about which accounts you save to in what order, you can maximize the tax advantages of the money you're saving. In other words, by saving the same amount of money but using the right accounts, in the long run, you'll end up with more money after taxes. So using the right accounts maximizes how far the money you save ends up going for you. I guess it's kind of like the waterfall of teams for your sports fanhood. First you have Michigan football, then Michigan basketball, then the Lions, although after this past season, I think Michigan basketball might have jumped ahead of football.
Yeah, no, I try not to play any favorites with my Michigan fanhood waterfall, but I will say the Lions are definitely at the very bottom of it.
Fair enough. Well, why don't you kick things off for us by talking about the first account physicians should prioritize when saving for retirement?
Sure. The first account we want to cover is the most common employer retirement account, and probably the one most people have heard of, and that's a 403B or a 401k. Both the 403B and 401k are retirement accounts offered by your employer that allow you to contribute money directly from your paycheck and then invest your contributions by choosing among the different investment options offered by the plan. People often wonder what the difference is between a 403B and a 401k, and it's pretty simple. The two accounts are essentially the same in terms of their characteristics and tax treatment, but if you work for a nonprofit employer, you'll have a 403B, and if you work for a for-profit employer, you'll have a 401k, but they're basically the same thing. And while those are the two most common employer retirement plans, if you work for the federal government, you'll have something called a thrift savings plan, which is essentially the same as a 403B or a 401k plan, but for federal employees. The TSP plan often comes into play for physicians who work for the VA in some capacity. But given that most of the large health systems in our area are nonprofits, U of M, Beaumont, Henry Ford, St. Joe's, IHA, the 403B is definitely the most common for local physicians. And the reason we put the 403B and 401k first in the order of retirement savings accounts is because of something called an employer match. The way an employer match works is that you contribute a certain percent of your salary to the account, and your employer then matches or makes a contribution on your behalf up to a certain amount. The amount of the match varies by employer. For example, University of Michigan offers the most generous match of all the local employers with a 2-for-1 match up to 5% of your salary. So if you contribute 5% to their 403B base retirement plan, U of M will contribute another 10% on your behalf. Beaumont, Henry Ford, and the other employers also offer their own match. It's just a different amount. So as you can see, the employer match is essentially free money, and by not taking advantage of it, you would effectively be leaving part of your compensation on the table. So the most important first step in saving for retirement is maximizing your employer's match, which can be done by contributing at least up to the percentage of your salary required to receive the full matching contribution. This is another area where some confusion comes into play around making the quote-unquote maximum allowable contribution. In terms of contribution limits, for 2021, you're allowed to contribute up to $19,500 to a 403B or 401k, or $26,000 if age 50 or older, since the IRS allows an additional catch-up contribution. And we've seen people think they are maxing out their contributions, but are only contributing enough to get the full matching contribution, and may not be contributing up to the allowed $19,500 or $26,000. So it's important to check in on your 401k and 403b contributions to ensure you're taking full advantage of the maximum contributions. Now, when you contribute to a 403b or 401k, you typically have the option of making either traditional contributions, which are often referred to as pre-tax contributions, or making Roth contributions. The way traditional or pre-tax contributions work is that when you contribute the money, you receive a tax deduction for your contribution, so you don't have to pay taxes on that money. Once the money is in the account, it then grows tax-free over time, and when you eventually withdraw it in retirement, you have to pay tax on every dollar you take out. So you're effectively punting when you pay taxes to the future. The way Roth contributions work, on the other hand, is that you don't receive a tax deduction when you contribute the money today, but then the money grows tax-free, and you don't have to pay taxes in the future when you withdraw it. So rather than deferring the taxes on that money to the future, you're paying taxes now to avoid paying taxes on the money and the growth of the account in the future. And knowing the difference between pre-tax and Roth contribution, the next logical question is, which contribution is better? And if you were in the exact same tax situation today as you will be in the future, then both would be identical in terms of the tax benefits. However, that is rarely ever the case, and tax rates change over time. So when deciding on the financially optimal approach for you, it simply comes down to comparing what your tax rate is now to what it will be in the future when you withdraw the money. If your tax rate is higher now than you'd expect it to be in the future, pre-tax contributions are better. And if your tax rate will be higher in the future when you withdraw the money, Roth contributions are better. So as an example, for a physician in training earning $65,000 a year, this will almost certainly be the lowest tax rate they'll ever be in over their lifetime, which means Roth contributions are more beneficial. And following training and a large jump in your income, along with your tax rate, your years as an attending will typically result in you being in the highest tax bracket you'll ever be in, which makes tax deductions increasingly valuable. This is why it's typically best to make pre-tax contributions as an attending to maximize the current tax deductions available to you. Or said differently, minimize the amount of money you have to pay on taxes today at your current tax rate. Now, there are certain situations where this isn't the case, but since most physicians follow the same general path from a tax perspective, it typically is best to make Roth contributions during training and pre-tax contributions as an attending.
Yeah, and keeping on that same theme of tax benefits, the next account we're going to talk about is the only tax-advantaged account that has a triple tax benefit and can serve as another retirement account, which is a health savings account, or an HSA. And it might seem odd to talk about an HSA as a great way to save for retirement, but we'll explain the thought process here. And starting with a quick overview, an HSA is an account that was originally intended to help people pay for out-of-pocket healthcare costs that aren't covered by insurance. And the way it works is that you contribute money and receive a tax deduction for your contributions. Then once the money's in the account, you can either use it to pay for healthcare costs over time, or you have the option to invest it, similar to the way you could with any other investment account. And if you choose to invest your contributions, it grows tax-free. Then when you eventually withdraw the money, if you use it for qualifying healthcare expenses, like copays, prescriptions, dental costs, vision costs, etc., you don't have to pay taxes on it. So that's where the triple tax benefit comes from. So it's obviously a great account to use for healthcare-related costs. However, not everyone realizes that it can also double as a retirement account. And the reason for this is that after age 65, you can withdraw money from an HSA and use it to pay for anything, not just healthcare costs, without incurring a penalty. You just have to pay taxes on the money you withdraw, similar to your pre-tax 403b or 401k. The reason 65 is a magic number is that prior to that, if you withdraw money and don't use it for qualified healthcare expenses, you have to pay a 20% penalty plus the taxes. In addition to the tax benefits of an HSA, another reason we have it second in the order of priority for retirement accounts is that many employers make contributions to HSA accounts for employees who have them. This could be something like $500 or $1,000, but similar to the employer match for your 403b or 401k, it's free money. And for 2021, you're allowed to contribute up to $3,600 to an HSA as an individual and $7,200 as a family, plus an additional $1,000 if you're age 50 or older. And keep in mind, these are total limits between employee and employer contributions, so be sure to take into account any employer contribution. Now, one thing to note is that in order to be eligible to contribute to an HSA, you have to be enrolled in an eligible high-deductible health insurance plan. The IRS defines this as a plan with a deductible of at least $1,350 for an individual or $2,700 for a family. And not every employer offers an HSA-eligible health plan. For example, U of M doesn't offer one, but Beaumont and Henry Ford do. So while essentially all employed physicians have access to a 403b or 401k, not everyone has access to an HSA. But if you do, it's the next best place to save for retirement after your 403b or your 401k.
Yeah, I think our Gen should probably make fun of us more for how excited we get about accounts with a triple tax benefit.
Yeah, they probably should. I guess they like to take it easy on us.
All right, well, the next account that we're going to go through in the waterfall of savings isn't quite as exciting as a triple tax-free account, but it still provides an additional tax benefit for your contributions. And as I mentioned earlier, for most physicians, the years you spend working as an attending will be the years where your income and tax bracket are the highest. And therefore, the value of the tax deductions is the highest. So the next account we'll discuss is another one that allows you to take advantage of tax deductions, and that's a 457B. And just to start out, it's worth mentioning that not every employer offers a 457B. But if your employer does, it's another great way to save for retirement in a tax-advantaged way. Now, in terms of the way a 457B works, it's very similar to a 403B or 401k for the most part, although there are some differences which we'll highlight. But starting with the similarities, the 457B allows you to make contributions, either pre-tax or Roth, depending on the plan, invest the money, and allow it to grow tax-free over time, then withdraw it in the future to use in retirement. The contribution limits are also the same. For 2021, it's up to $19,500 or $26,000 if 50 or older. And while the contribution limits to a 457B are the same as it is to a 403B or 401k, it's important to note that you can contribute $19,500 or $26,000 to your 457B in addition to the $19,500 or $26,000 that you contribute to your 403B or 401k. In terms of differences, one of the biggest ones is around early withdrawal penalties. With a 403B or a 401k, if you withdraw the money before age 59.5, you have to pay an early withdrawal penalty of 10% of the amount you withdraw, in addition to the taxes you owe on the withdrawal. And whereas with the 457B, there are no early withdrawal penalties. So in that sense, the 457B can be a great account for physicians with the goal of early financial independence before age 59.5. We have some clients who are planning to retire as early as age 50 or 55. And for them, we don't want to tap into their 403Bs or 401ks during their early years of retirement and have to pay a 10% penalty. So we have the option of using their 457Bs, or taxable accounts, which we'll discuss in a bit, instead. The only other requirement for you being able to use your 457B penalty-free before age 59.5 is that you're no longer working for your employer. So being able to avoid those early withdrawal penalties is definitely one of the biggest positives of the 457B compared to the 403B or 401k. But there are also other drawbacks, which is why we put this account lower in the priority order. One of these is that unlike a 403B or a 401k, the assets in a 457B plan are considered to be owned by the employer until they're actually withdrawn by the employee. So in that sense, if your employer ran into financial issues or went bankrupt, the 457B assets could be taken by creditors. Now, we know this is a less likely scenario, but it's something to be aware of, especially thinking back to the earlier stages of COVID when the financial situations of many health systems looked pretty shaky. Another reason we put the 457B lower than the 403B and 401k is because of some of the things you can run into on the back end when it comes to time to withdraw your money. And the key distinction we want to make here is between governmental 457Bs and non-governmental 457Bs. And the names explain the difference. Governmental 457Bs are offered by government employers, while non-governmental 457Bs are offered by non-governmental employers. So for example, U of M's 457B is a governmental 457B, whereas Henry Ford and Beaumont's 457Bs are non-governmental 457Bs. And the reason this matters is that non-governmental 457Bs are more restrictive when it comes to rollovers and withdrawals. With a governmental 457B, when you leave your employer, you can roll it over into an IRA, similar to what you can do with the 403B or 401k, and manage it yourself. With a non-governmental 457B, you can only roll it into another non-governmental 457B plan. So if you move to a different employer that doesn't offer or have a non-governmental 457B plan, your money is stuck with your old employer until you decide to withdraw it. And when it comes to withdrawing money, there tend to be more restrictions for non-governmental 457B plans. Many plans require you to withdraw the money on a set schedule over a certain period of time, as opposed to governmental 457B, where you have more freedom in deciding how much you want to draw each year and on what schedule, which provides a lot more flexibility when it comes to tax planning and being strategic about how you withdraw from your retirement accounts to minimize taxes. So overall, a 457B offers some great benefits, including the ability to save on taxes and withdraw money prior to age 59.5, but it also has some of these drawbacks we discussed, which is why I put it lower in the priority order of retirement accounts.
Now, the next account we're going to discuss is one that people sometimes don't realize they have access to, and that's a backdoor Roth IRA. And before explaining what the backdoor Roth IRA is, I'll give a quick overview of what an IRA is. An IRA is an individual retirement account, and as the name implies, it's a retirement account set up by an individual. So it's another retirement account available for people outside of their employers, and it offers the same potential tax advantages as a 403B or 401k. The only difference between IRA accounts and employer retirement accounts is that there are restrictions on the tax benefits and eligibility to contribute if you make over a certain amount of money, which I'll touch on in a second. And this is where the backdoor Roth IRA comes into play, which is effectively the same thing as a regular Roth IRA, but contributing to it involves a couple extra steps because of the income limitations I just mentioned. And the way a Roth IRA works is that you contribute after-tax money, so you don't receive a tax deduction for your contribution, but once the money is in the account, you can invest it and it grows tax-free. Then when you eventually withdraw the money in retirement, you don't have to pay taxes on the money. So once the money is in the account, you never have to pay taxes on it again, assuming you make a qualified withdrawal when you take it out. Now, as I mentioned, one of the key things about Roth IRA contributions is that there are income limits for making them. For example, if your modified adjusted gross income for 2021 is above $140,000 if filing taxes single, or $208,000 if filing taxes jointly, you aren't eligible to contribute directly to a Roth IRA. Therefore, most physicians are precluded from making direct contributions. However, you can still contribute using the backdoor method. And what this involves is making a contribution to a traditional IRA, for which you don't receive a tax deduction, because of the income limitations, so it's referred to as a non-deductible IRA contribution, but you then immediately transfer or convert the traditional IRA contribution to a Roth IRA, and then report the transaction at tax time using a specific form called the Form 8606. And it's kind of a funny system because the IRS has the income limits for direct Roth IRA contributions, but at the same time, it's explicitly blessed the backdoor Roth IRA. So until the laws eventually change, this is something you can take advantage of since it's effectively the exact same thing as making a direct Roth IRA contribution, but with a couple extra steps. And in terms of contribution limits, for 2021, you can contribute up to $6,000 or $7,000 if you're age 50 or older. Now, one important thing to note, before considering making a backdoor Roth IRA contribution, you'll want to confirm whether you have any money in a pre-tax IRA account, which includes a SEP IRA, rollover IRA, traditional IRA, or simple IRA, whether that's from rolling over an old 403B or 401k or making retirement contributions for any side income you might have. The reason this is so important is because of something called the pro rata rule, which creates issues with the backdoor Roth IRA contribution where you may inadvertently have to pay taxes on a portion of your backdoor Roth IRA contribution. So you'll want to fully understand the pro rata rule and check with your tax professional before making any backdoor Roth IRA contributions. And when thinking about the benefits of a Roth IRA, I already mentioned the tax-free growth and the tax-free withdrawals, but another nice benefit is flexibility with withdrawals and passing along the account to heirs. So for a traditional IRA account and also pre-tax 403B or 401k, there's something called required minimum distributions. The way they work is that once you turn 72, the IRS requires you to withdraw a certain percentage of the account value each year based on your age. The reason for this is that when you originally contributed the money to those accounts, you received a tax deduction, and the IRS eventually wants to get paid, which doesn't happen until you withdraw from those accounts, so the IRS requires you to start withdrawing at a certain age, whether or not you need the money. But the nice thing about Roth IRAs is they don't have these required minimum distributions. So if you don't need the money to fund your lifestyle, you can let it continue to grow tax-free in the account. Another nice thing is that once you eventually pass away, your heirs inherit an account with flexibility for when to withdraw the money and no tax that needs to be paid. On the other hand, when your heirs inherit a traditional IRA, they're required to, in most situations, withdraw the money and pay the associated taxes within 10 years of inheriting it, whether or not they want to withdraw the money. So Roth IRA accounts are a great way to pass assets along to your heirs in a way that's tax efficient for them. That being said, despite these benefits, the reason we have the backdoor Roth IRA lower in the priority list of retirement savings accounts is because of the lack of tax deduction for contributing to it. As we mentioned a few times now, for the majority of physicians, your tax rate will be higher during your years working as an attending than it will be in retirement. And therefore, you want to maximize all the tax deductions that are available to you today, since tax deductions are worth more when your tax bracket is higher. For 403Bs, 401Ks, health savings accounts, and 457Bs, contributions can all be made on a pre-tax basis, which provides a tax deduction today. So you generally want to max out those accounts before moving on to the backdoor Roth IRA, which provides its own tax advantages, but doesn't offer a tax deduction for your contributions.
So when thinking about saving for retirement, we always advocate for filling up all of your tax advantage savings space first. And the reason for this is that money saved to tax advantage accounts will go farther and you'll end up with more money after taxes than you would have if you saved the same amount and invested it in the same way in a different account without tax advantages. Each of us has a certain amount of tax advantage saving space available to us. And for most employed physicians, that will be some combination of a 403B, 401k, health savings account, 457B, and backdoor Roth IRA. Now that alone allows you to save a lot toward retirement each year, but many physicians are willing and able to save even more, so the final account in the waterfall of retirement savings is a taxable account, which is essentially a catch-all for any money saved after maxing out the other accounts. A taxable investment account is sometimes referred to as a brokerage account, a joint account, or an individual account. So know that all of these are the same things. And as the name implies, a taxable account doesn't carry with it the same tax advantages as the other accounts we've discussed. You don't receive a tax deduction when you contribute to the account. You have to pay taxes on the interests and dividends kicked off by your investments each year. And you have to pay taxes on any growth of your investments when you eventually sell them. So while that might not sound that great, there are a number of advantages to a taxable account, and it's a much better alternative than just saving to a bank account. One of the biggest advantages is flexibility. Unlike a 403B, 401k, Roth IRA, where you have to pay a penalty if you withdraw money prior to age 59.5, or a 457B, which has its own withdrawal requirements, you're free to withdraw money from a taxable account at any time with no penalty. You just have to pay taxes on the gains from the investments you sell. And even then, if you've owned the investments for more than a year, you're able to pay taxes at a preferential long-term capital gains rate, which for most physicians are at 15% and are much lower than ordinary income tax rates. Having money in a taxable account also provides flexibility for tax planning retirement. As we've talked about in other podcast episodes, there are some key windows between retirement and age 72 that offer the opportunity to lower your lifetime tax bill through proactive tax planning. And a key component of this is having a taxable account that you can draw from to fund your living expenses during those earlier years of retirement. It's also worth looking at a taxable account compared to the alternative of simply saving to a bank account. While most banks continue to pay close to 0% interest for keeping your money with them, when you save it to a taxable account, you're able to invest it with the expectation and potential of earning a much higher rate of return over time. You also have complete flexibility with your investment options compared to many employer retirement plans where you have to choose among a set list of funds. So as you can see, a taxable account is nice to have for a variety of reasons, but because of its lack of tax advantages compared to the other accounts we discussed, it comes behind them in terms of the priority of retirement savings.
So that covers it with our discussion of the waterfall of retirement savings accounts, and hopefully that was useful in providing some perspective for how to view and prioritize some of the different accounts and some of the thinking behind it. And we know each person has access to a different set of accounts, but hopefully you can now have some confidence that you're using yours in a way that's going to maximize the impact of your savings. And just to summarize the order of priority, number 1 is a 403b or 401k, so make sure you're taking advantage of your employer's match, which is essentially free money, by contributing to your 403b or 401k. Number 2 is a health savings account. So if you're enrolled in an eligible health insurance plan and have access to an HSA, use it to take advantage of the triple tax benefit and have an account to tap for healthcare costs or other costs after age 65. Number 3 is a 457b, if available. Take advantage of additional tax deductions and early withdrawal potential for early financial independence by contributing to a 457b. Number 4 is a backdoor Roth IRA. Assuming you don't have any money in a pre-tax IRA, consider making backdoor Roth IRA contributions to fill out your tax advantage savings space. And lastly, number 5 is a taxable account. So for any money left over after maxing out all of your tax advantage accounts, consider a taxable account for the flexibility it provides. Well, thanks everyone for joining us for another episode of the show. If you want to check out the show notes, you can find them at mdwmllc.com/podcast. As always, you're also welcome to email us at info@mdwmllc.com if you have any thoughts or questions to share. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.